Mutual funds are incredibly popular investment products that investors like you and I can invest in, but there are some serious problems that you need to know about mutual funds that can have a serious impact on your long-term investment performance. In this video, I'm going to tell you exactly why mutual funds can be problematic investments and things you can do instead to likely improve your investment performance over a long period of time. Stay with me. Before discussing the big problems associated with mutual funds, first, I want to quickly explain what a mutual fund is, just in case you're unfamiliar with what mutual funds are. A mutual fund is a pool of investor money, with investors being people like you and I, that is then invested into investment products such as stocks, bonds, currencies, or whatever that particular mutual fund invests its funds in. A mutual fund allows investors like you and I to purchase into the mutual fund and get exposure to diversified portfolio holdings that are professionally managed, and we're able to do that because the mutual fund collects money from a lot of investors and pools that money together and then allocates that money in a diversified way. And as an investor in that mutual fund, we will own a small percentage of that fund and therefore participate in the future growth or lack of growth in that fund's holdings. As a simple example, if a mutual fund collects $1 million of outside investment from investors like you and I've personally invested $50,000 into that particular mutual fund, I own 5% of that mutual fund's holdings. Now let's say that mutual fund did very well over the next 2 years, and 2 years later that mutual fund's holdings were worth $1.5 million. Since I had a 5% stake in that mutual fund, my 5% stake of a $1.5 million mutual fund would be $75,000. So since the mutual fund's initial value was $1 million and it appreciated 50% to $1.5 million, my initial $50,000 investment also appreciated by 50% to $75,000. So the great thing about mutual funds is that with a relatively small amount of money, you can get exposure to a very diversified portfolio of holdings, but there are some big problems associated with mutual funds, which we're going to talk about right now. The first big problem with mutual funds is that they can often require a high minimum to get started investing in that fund. For example, it's not uncommon for a mutual fund to require an initial investment of $2,500 or $5,000, sometimes significantly more, just to get started investing in that fund. In this particular mutual fund, the initial investment requirement is $2,500, which is a pretty large sum of money just to get involved investing in the stock market. A high initial investment requirement means that mutual funds can be less accessible to smaller investors compared to investing in the alternative products that I'm going to discuss a little bit later in this video. The second and perhaps the most sinister problem with mutual funds is what's called a load. A load is a fee that you pay when initially buying into the mutual fund or when you sell your stake and exit that mutual fund. It's called a front-end load fund when you pay that fee or commission before buying into the fund, and it's called a back-end load fund when you pay that fee or commission when exiting or selling that mutual fund. As an example, if you invested $10,000 into a mutual fund with a 5% front-end load, you would pay a $500 fee or commission to that mutual fund, typically the broker who put you into that fund, for simply getting started investing in that mutual fund. That means $9,500 will actually be invested in the mutual fund, and the other $500 is a fee that goes to the broker who put you into that fund. Load funds incentivize brokers to put you into those types of funds because that increases their compensation by charging you a high fee when you enter or exit that mutual fund, and clearly that's not in your best interest. The third big problem with investing in mutual funds is that a vast majority of mutual funds underperform the broad stock market as measured by something like the S&P 500 index. In a recent CNBC article, it was stated that a large majority of large cap mutual funds underperformed the S&P 500 for the 9th year in a row. More importantly, over a longer period of time when analyzing the mutual funds, a higher frequency of funds were found to underperform the S&P 500 over that period of time. The fourth big problem with investing in mutual funds is that they typically charge a very high annual management fee, which is referred to as the expense ratio. It's not uncommon for a mutual fund to charge upwards of 1% a year in management fees or having an expense ratio of greater than 1%. A 1% expense ratio means that every single year, you're going to lose 1% of your total investment in that mutual fund to the management fees. I know 1% doesn't seem like a lot, but over a long period of time, paying a 1% fee compared to paying a 0.1% fee can lead to significantly lower returns over a long period of time, which is clearly not a favorable scenario for you as a long-term investor. At this point, we've determined that mutual funds typically have a high initial investment requirement, which makes them less accessible to you. Second, they sometimes charge a load fee, which is a high fee or commission that you pay when buying into that mutual fund or when you sell that mutual fund. Third is that most mutual funds underperform the broad stock market, especially over a long period of time. And fourth, most mutual funds charge a very high expense ratio or high annual management fee, which means on a yearly basis, you're going to lose a pretty decent chunk of your investment to that fund's management fees. So what's the solution to these problems with investing in mutual funds? The solution is to consider investing in exchange traded funds, or ETFs, instead of buying into mutual funds from individual investment companies. So what is an ETF? An ETF is just like a mutual fund, except the ETF shares are listed on a public stock exchange. Instead of going through an investment company and dealing with the high initial requirements to get invested and dealing with the high fees when investing in that company's mutual funds, you can buy and sell shares of an ETF directly from your brokerage account. There are broad stock market ETFs such as SPY and IWM that you can get started investing in, and those products have relatively low share prices, charge virtually 0% in annual management fees, and therefore you will get the returns of those products and those stock market indices on a yearly basis, less the small amount of fees that you pay, which is almost 0%. In particular, SPY is an S&P 500 ETF, which tracks a broad basket of large cap stocks across all sectors in the US economy. As of this video, a share of SPY is about $300, which means for $300, you can get exposure to about 500 companies across all sectors of the US economy, and you'll pay close to 0% in fees for investing in that ETF. I mentioned load fees with mutual funds, which is a high commission that you pay when entering a mutual fund or when you sell the mutual fund. One big benefit of ETFs is that there are no load fees when buying or selling shares of an ETF. Just to show you how popular SPY is as an ETF and investment product, according to recent data from NASDAQ.com, the 50-day average daily trading volume for SPY was just under 100 million shares. Lastly, and more importantly, when you buy shares of an ETF, you are going to earn the return of what that ETF tracks on a yearly basis, less the fees that you pay, which are minimal. So what are some popular ETFs that you can consider investing in? I'm going to do a completely separate video describing popular ETFs and what they track, but here are a few to consider. The most popular and liquid stock market index ETF is SPY, which is one of the S&P 500 ETFs. As of this recording, the annual expense ratio for SPY is 0.09%. IWM is the Russell 2000 stock market ETF, which tracks the Russell 2000 stock market index. The current annual expense ratio in IWM is 0.19%, or 19 basis points. That means you're going to pay $19 in fees for every $10,000 invested into shares of IWM. Investing in a small cap ETF like IWM means that you are investing in small cap companies or companies with smaller market capitalizations. Investing in smaller companies carries more risk, but also more potential reward. QQQ is another popular stock market index ETF, but it's one of the stranger ones because QQQ tracks the NASDAQ 100 index, and that tracks non-financial companies that are listed on the NASDAQ stock exchange. QQQ, while not a pure technology fund, is pretty tech heavy, meaning that when you're investing in QQQ, you will be getting exposure to lots of companies in the technology sector, which, just like IWM, means that when you're investing in QQQ, you are investing in another high volatility stock market ETF. As of this video, the QQQ expense ratio is 0.2%, which means you'll pay $20 in annual management fees for every $10,000 invested into shares of QQQ. I've just gone over a few stock market ETFs, but not all ETFs track broad baskets of stocks, as some ETFs actually track single commodities such as bonds or gold or silver. It's important to understand this because not all ETFs give you exposure to diversified portfolio holdings, as if you're investing in a bond ETF or a gold ETF, you're going to be getting exposure to just those commodities and you will not be getting exposure to a broad basket of stocks, which means you won't have a diversified investment. TLT is one of the most popular bond ETFs as it is the long-term US Treasury bond ETF that targets US Treasury bonds with maturities greater than 20 years. As of this video, TLT's annual expense ratio is 0.15%, which means you'll pay $15 in annual management fees for every $10,000 invested into shares of TLT. The gold ETF is GLD and the silver ETF is SLV. Both of these ETFs track gold and silver respectively. As of this video, GLD has an expense ratio of 0.4% and SLV has an expense ratio of 0.5%, which is getting to the higher end of ETF expense ratios, but still pretty low nonetheless. The benefit of GLD and SLV is that you can get invested into gold or silver without significant sums of money, and another benefit is that you don't have to physically buy gold or silver, which means you don't have to sit around with lunks of metal in your house. I'm not recommending that you invest in GLD and SLV, as I see them as much more speculative ETFs compared to investing in a broad stock market ETF like SPY, but GLD and SLV are two examples of ETFs that track things other than broad stock market indices. Please leave a comment down below this video if you have any questions or if you just want to show some love. And if you're new to the channel, please consider subscribing by hitting the subscribe button and also clicking the bell so that you don't miss out on any of my future videos. I hope you all enjoyed this video and found it to be informative. Please give the video a like if you enjoyed it. My name is Chris Butler and I will see you in the next video.